Hello everyone, my name is Lisa Edmunson from Amber Wills Estate Planning Services, and I'm here today to talk about wills, powers of attorney and protecting your estate for your loved ones when you pass. So this is me, Lisa Edmunson. I run my own business. I'm based in Swanwick near Alfreton, and I'm happy to help with any queries that you might have. So if I just start first of all. So estate planning, lots of people don't know what it is. So it's the preservation of wealth through tax and estate planning. In practice, it can cover a large number of potential planning areas like lifetime tax planning, and that includes inheritance tax, capital gains tax, income tax. It can include structuring trusts and other entities, and also includes pensions, insurance and investments. And the bit where I come in is that I write your wills and your powers of attorney. So I'm just going to talk about it all a little bit more and explain it. So making a simple will. A will does not necessarily cover everything you own. Making a simple will without checking all your assets and taxation position properly can lead to missed opportunities for tax savings. Valuable assets passing outside your estate, such as pensions, are often forgotten. Many assets, especially business assets, have significant tax reliefs which can inadvertently be lost by failing to plan. Asset protection, that's leaving assets in a trust, in a will, or on death, can protect them for beneficiaries and stop them passing outside of the family in the event of second marriages or being exhausted by care fees or creditors. So how do we make a will? With the changes that came in last year with the COVID, video calls are now prevalent. So we can have a Zoom call, which can make the process quite quick and easy to manage remotely, or I can come to your home or your office, and obviously following COVID-19 rules, I can see you face to face, which some people prefer. A will must be signed by the person making the will, or at the direction if they cannot sign due to illness or poor eyesight, in the presence of two independent witnesses. Now, those two witnesses can't be beneficiaries of the will or anyone that they are married to or in a civil partnership with. If this does happen, it will have disastrous consequences and the beneficiary will not inherit. So it completely wipes out the whole idea of what you were setting out to do. Legislation introduced last year because of COVID did allow for online witnessing of wills, but I'd rather not do this because it's a last resort and it's best avoided because there is room for it to be abused. So I do prefer face-to-face signing. So some people think, well, why do I need to make a will? You know, I just leave it as it is and it'll all get sorted out. Well, that's not necessarily the case. So you must keep your will up to date. If you've previously made a will, this will probably still be valid, even if it was made years ago. But ideally, wills should be checked for relevance every 2 years. If you don't have a will or it's become invalid because you've married or got divorced, then the statutory rules of intestacy come into play. Also, wills which are improperly executed can be partially or completely revoked. So as you can see from this slide here, the rules of intestacy, it depends, the rules of intestacy depend on various things. So whether you're married or in a civil partnership, if you're not married or in a civil partnership, then your estate is distributed among surviving relatives in order of closeness of relationship. So it begins with your children, and it extends right through to aunts, uncles, half aunts, half uncles, and so on. If you don't have any surviving relatives at all, everything goes to the Crown. Okay, so you're allowed an allowance of £270,000. So if you're survived by your spouse by 28 days and your estate is worth more than £270,000 and you're survived by your children or direct descendants, that can include adopted children or your grandchildren, then your spouse gets all of your personal possessions and the first £270,000 of your estate, plus half the residual estate. And then your children, once they get to 18 years old, receive the other half of the residual estate. I know that all sounds a little bit complicated, but if you take time to look through the slide, it might become a little bit more apparent. So a lot of people are part of death in service schemes. They are free of inheritance tax, so they're an effective way to provide a lump sum to your children, grandchildren, or to a trust. You must make sure that you have nominated whoever you want the death in service amount to go to, and that needs to be done in writing to the scheme trustees. When you started with an employer, you were probably asked to fill out this form right at the beginning, but it's worth just checking if that is in place. So the death in service money can be paid into a trust without any tax charges. But you need to just check again with the trustees that the sum that you would receive is allowed to go into a trust. Not all of them are. And there's also such a thing as a spousal bypass trust. So your spouse can be a beneficiary of the trust with your children. So they have access to the funds, but they don't form part of your estate for inheritance tax purposes. So that's another good way of saving money. So on a payment of, say, £300,000, there'll be a potential saving of £120,000 on inheritance tax. So, points regarding inheritance tax planning. The rules are complex, but there are tax reliefs available. Lifetime tax planning for inheritance tax and capital gains tax can save many thousands of pounds and protect your assets. The use of trusts, lifetime gifts, business assets, farming assets, charitable gifts, and certain investments should be considered when planning personal or business succession and when structuring a will. So, inheritance tax, will my family have to pay it? Well, that all depends on the size of your estate and what's in it. So, assets transferring to a surviving spouse, but not an unmarried partner on death, are inheritance tax free, assuming that you live in the United Kingdom. So, due to spouse exemption relief on their first death, married couples may pay no inheritance tax at all. So, the current personal nil rate band, i.e. the maximum amount that can be left to your beneficiaries without inheritance tax being payable, is £325,000. So if your estate is less than £325,000 in total, including your assets, savings and everything like that, you won't need to pay any inheritance tax. The transferable nil rate band, that's another £325,000, of which is unused on the first death, can be used by the surviving spouse to combine with their own nil rate band. So basically, the nil rate band of £325,000 is transferable between spouses. On top of this, there is the residence nil rate band. That's another £175,000. And again, this is transferable between spouses. So you've each got an allowance of £500,000 if you own property. So the residence nil rate band is not available where estates commonly on second death exceed 2 million in gross value. Those with an estate close to 2 million will need to take planning advice to ensure that the residence nil rate band relief of as much as £350,000 is not lost, which can be done in a variety of ways, including gifting. Also, a resident nil right band could lead to a tax bill. For example, £350,000 at 40% is £140,000 inheritance tax. So the resident nil rate band, RNRB, can be inadvertently lost when downsizing and gifting to family prior to death, but with correct tax planning advice, this can be preserved. Descendants are classed as children, grandchildren, or another lineal descendant. Some classes, such as nephews, nieces, siblings, and other relatives, are excluded. Leaving a property to an unmarried partner could waste your residence nil rate band if the property ultimately is to pass to your children when your partner dies. This can be avoided and the relief preserved with the right structure of your will. So, nil rate band issues and wins. There is no spouse exemption between unmarried couples, which I think I mentioned before, and the nil rate band is not available to the surviving partner. As with residence nil rate band, the nil rate band is not transferable to an unmarried partner. The nil rate band can be used and reused in your lifetime. An individual can put property, i.e. cash, shares and property of up to £325,000 in value into trust, and provided they survive 7 years, it will fall outside their estate and for inheritance tax purposes. They will then have another nil rate band of 325 to use. So, good result. A married couple can settle up to a combined £650,000 to trust, which after 7 years is completely outside their estates for inheritance tax purposes, and they have £650,000 of nil rate band to use again. Okay, so we'll now move on to business property relief opportunities. So, for business owners, the key inheritance tax relief is called business property relief. 100% relief can be claimed on business assets owned for over 2 years and related to a trading company. By saying trading, investment companies don't qualify. So chalets, caravan parks, anything you've invested in doesn't qualify for BPR. But if you do, you get 50% relief on assets owned personally, but used in the business. This can be used in lifetime planning by settling assets into trust which qualify for BPR. Assets in the hands of spouses or other beneficiaries after death may not qualify for BPR. So, structuring your will. We need to review your company structures. Property investments within trading companies can create issues for BPR. Review your wills to make sure BPR assets pass into trust on first death. So, bringing all of that together, inheritance tax savings are available using nominations and trusts for assets that pass outside of the will. There are risks if planning is based on being in work and insurance in place at time of death and it is not, or pension goes down or up in value. Discretionary trust wills are useful as a mechanism to rebalance other pots. You have a choice of executors and trustees. Obviously, you need to choose people that you trust implicitly. And you can also produce overarching letters of wishes, which cover the different pots. The letter of wishes are not legally binding, but are there to give your trustees and executors guidance as to how you want the trust to be used. So if we move on now to lasting powers of attorney. Okay, lots of people hear about powers of attorney and they sometimes think that they're just used for the elderly. So if mum or grandma's getting a little bit infirm and they can't make it to the bank or the building society to get their money, they put powers of attorney in place so that their relatives or whoever they choose can act for them. This isn't necessarily the case. So getting a lasting power of attorney in place can be useful if an individual were to lose mental capacity for any reason. And it's always a sensible precaution. So if someone was younger and they happened to have an accident and were incapacitated and in hospital for, say, 3 months, they wouldn't be able to pay their bills, pay their staff if they've got a business, pay their creditors and things like that. So it's always useful to have these in place. So LPAs come in 2 different versions. There's the property and financial affairs and the health and welfare. Obviously, property and financial affairs looks after things like paying your mortgage, paying your rent, paying your bills, things like that. And health and welfare ensures that your attorneys have a say in how you're being cared for. If they're not in place, then the clinicians will just make the decisions themselves. So they have the benefit of control, because you say how you want the executors to act, and also it saves you a cost, or your loved ones a cost, an administrative burden, because if you don't have powers of attorney in place, you need to obtain a deputyship from the Court of Protection. This process can take around 12 months to put in place and cost £1,200 to £1,500. I've even heard it costing £2,000. And obviously at a time when your loved ones are worried about you and your health, they don't want all of this extra aggravation. So for a few £100, you can put powers of attorney in place and it's all sorted. And it just ensures that if you have a business, it just continues to run and there aren't any hiccups. So the probate process, dealing with an estate is still possible and can now be done online, which is a huge boost. And there are opportunities for planning on death to protect assets and save tax. So getting a grant of probate and checking if all the inheritance tax allowances can be claimed is not straightforward. A will can be varied to obtain inheritance tax release for the benefit of the beneficiaries post-death, but obviously it has to be in agreement with all of the beneficiaries. And if the probate process isn't carried out correctly, then there are penalties, unfortunately, from HMRC. So if we were to carry out probate, then an estate questionnaire would need to be filled out. We need to notify all the relevant asset and liability holders, compile a schedule of assets and liabilities of the estate, and then various forms need to be completed. So there's the IHT 205 or IHT 400 and the accompanying schedules. They're for HMRC purposes. And then we need to complete the probate application forms along with the IHT receipt from HMRC to the probate registry. So to conclude, if you don't make a will, you risk the intestacy rules applying, often with random and unwanted consequences. You don't want your estate being left to relatives that you haven't seen for years, you don't know, and if you do know them, you might not even like them. The current combined inheritance threshold for a married couple can be as much as 2 million, but only in certain circumstances. Don't inadvertently waste the available allowances. Pension trusts and death in service schemes can be used for additional inheritance tax saving. Lifetime planning is critical for business owners. In business sales and succession, using BPR to inheritance tax can save thousands in tax and protect assets. So what is often seemingly a most simple set of circumstances can end up being complicated, and it's wise to identify all of one's assets and plan effectively to save tax, protect assets, and more importantly, our loved ones. On the other hand, you may think that your circumstances are too complicated and you cannot face thinking about putting your affairs in order. I found this quite common amongst people, but then once we talk about things and go through their circumstances and what they want to achieve in writing their will, they become a lot more relaxed and can see that it isn't as daunting as they once thought. So best practice is get professional advice and make a will. So I offer my clients a free, no obligation consultation to discuss their circumstances and what they would like to achieve when writing their will. I can meet them in their own home or at work in order to discuss various options, explain the benefits and limitations of each. Once I've taken instructions, I send out a draft version of the documents to clients for their approval. Once they're approved, I arrange for documents to be validly executed with the will writer and in the presence of 2 independent witnesses. I then offer storage for the wills in a safe environment that is fire and waterproof, but I also provide copies to my clients. So I hope you found that interesting. It can be a bit of a minefield, but if you want to know anything else or just have a quick chat, please don't hesitate to get in touch with myself. There are my details on the screen now. And I know that Carl at Sunny Accountants is also happy to discuss any concerns that you might have. So thank you for listening, everyone.